In one of the presentations that I had mentioned recently was to look at a married put and the recent income methods, and that was related to the ANET trade and the Newmont mining trade. So let's take a look now in power options and go into the portfolios where we have these positions being tracked. And what we had done recently is with the ANET position, it was originally opened at 120.47 on October 4th. And we had opened it initially with a 125 strike put for about a 7.5, I believe, maybe it was actually 8% risk on the position. Well, as the stock moved up, using the guidelines and the rules in the blueprint, excuse me, for the various income methods, we adjusted the put up and strike to lower the risk. We originally sold a 130 call, which we were able to roll up for a credit to the 133 strike as the stock continued to move up. But now the stock is above our new strike price, and I decided not to roll it yet because we still have 14 days to expiration. But if we take a look at the profit and loss chart for the ANET position, we're still in a good green range of potential profit here. We'd like to see that a little bit higher, right at 133. But now the stock moved up another 2% today. We're trading at 135.48. So the next decision that is made is when are we going to look to roll this new call? When are we going to look to move it up in price? As you can see by the profit and loss chart, as the stock continues to move up, we're coming off the maximum profit on the position. And this, of course, is due not just because we're in a structure where we bought a put option, rolled it up actually, to the 130 put, and now the stock's at 135. But what's happening here as the stock continues to move up is with just our stock and put combination, we still have a positive delta structure, where the put option is probably now at a delta of maybe 0.45, maybe 0.40. So every dollar the stock gains, we're still gaining 60 cents total on the stock plus put combination. But now that we've sold the call, and the call is now slightly in the money, this call is going towards a delta of 1, which is, of course, a negative delta. So we're not seeing any more positive gain or positive delta as the stock increases in price because it's countered by the short call. Now, I mention this because some radioactive investors have been asking, well, the stock's moved up, it's above my short call. Should I consider moving up my put at this time? Well, the trick in this structure, just using income method number 1 on the married put structure, the proper radioactive trade that's discussed in the blueprint, is that I need to address the short call first. That's what's hindering the position the most and causing this to go into a negative value as the stock continues to move up in price. Not negative yet, would have to go really high, up to about 160 or 170. Let's clear those drawings out here real quick. And let's lower this down so you can see those prices. So we don't actually start going into the negative till we hit about 162, 163. But we are losing maximum profit in this case because of the obligation of the short call and the total cost basis on the overall position. But as you can see, we have a nice limited risk of only 4.2% on the position and a potential max profit of 5.3% if the stock's trading right around 133 or so. So should I move the put up now, in this case, before adjusting the call? Not really. In our opinion, it's the call that is starting to hinder the movement and hinder the profit to the upside. That's why we're seeing that decline, because we're not seeing any more positive delta. Now, if I just close the call, of course, in this scenario, it looked like the cost was around 520, I think, or 530 or so, last time I checked before the market closed. But let's take a look. It's the December 2nd call we have open, the 133 strike that we moved up. Yeah, it's right around 525 now, maybe a little bit higher, 535 at midpoint. Now, we did receive about 385 for this call. But if we just bought it back right now to cancel the obligation, we'd go back to a risk of 7.8%, But now our upside still remains open on the position. We still have the ability of the positive delta without the call, but we do increase our cost basis up to 14,107, and the risk goes back to 7.8%. Of course, just like in a covered call position, the best approach would be to roll this call to a higher strike price if we can roll for a credit. Now, instead of trying to go through that same scenario of going through the view options and seeing which call I could roll for a credit, as I'm tracking any position in the portfolio tool, whether it be just a standard covered call, a cash secured naked put, a credit spread, even an iron condor perhaps, but a married put or a standard collar, we can link directly from the position to position actions and then position analysis. This will give us a breakdown of our current position. If I liquidated everything, a 3% profit, a little bit less than my target. At expiration in 14 days, if the stock remains around the same price, the time value decays out of the call, I have a profit of 4.6% for about 2 months into the trade, from October 4th until December 2nd expiration. That's at 14 days. Well, that's about 2.3% per month. That's pretty good. But we know that the buyback cost of our current call is around $5.30 at the midpoint price. What we see here are potential rollout opportunities following the rules in the blueprint. And we see we can roll out potentially to maybe just 21 days, an extra 7 days out in time to December 9th, but we're not seeing the ability to roll for a credit. Yes, we originally received $385 for the premium, but the buyback cost right now is $530. I'd like to see a premium of at least $530. We don't see that until we go out to the 23rd of December, 35 days away from today, an additional 21 days from where our current expiration on this short call is. But we could go up to the 136 call for $645, give us another $1.45 of net credit. And this would increase the max percent return we saw around 5.3% up to about 6.8%. 550, that's only 20 cents here. 590 at the 137, that's pretty good. A 60-cent premium, increasing the time frame by another 21 days. Still increases the percentage return on the position if the stock's trading right at the strike price as well. So there are opportunities to roll for a credit, but we're going to have to extend the time. Now, it's great to see things numerically, but as you link to the position analysis from the portfolio, you can click the More Information button here and go to Simulate Trade. The Simulate Trade will give us a side-by-side view of our current position over here on the left in red. There's our current maximum risk we saw of 5.2, the max percent return of 5.3. Again, if the stock's trading right at 133 on December 2nd expiration. And then, of course, our new position, if we roll up to the 136 call for a credit of about 115, buying to close our 133 at 530, selling the 23rd of December 136 call for 645. This takes our maximum risk down to 3.4%. Remember, we're still protected out to March. Another 3 months away, 2 3/4 months away if we've rolled out to the 23rd December position, and a new max return of 6.8%. Now, that's not too bad. Best case scenario, 5.3% return, which is including the theoretical value of the put price on our current position if the stock is trading right at 133 on December 2nd expiration, versus an increase of 1.5% for an extra 21 days of time. Not too bad at all, and lowering the risk by about 0.8% to 3.4%, with a profitability range showing all the way from about 120, probably again up to about that 165, 170 range. So this is a reasonable adjustment. This is a reasonable rollout opportunity, one that I will consider next week. Just holding off on Monday to see if ANET pulls back a little bit. We get a little bit of extra time value on this call option that we have here. As we can see, going back to this structure here, our time value remaining on the short call is 2.1% for 14 days. Maybe I'd like that to be a little bit under 1% if possible as we get closer to expiration. The risk, of course, of waiting is if ANET continues its strength and continues to move up in price, naturally the intrinsic buyback cost would be much higher in that scenario, but I'd still see opportunities to be able to roll for a credit, even if I'm rolling a little bit further out in time, increasing the potential return while lowering the risk as well. Now the reason, let me go back here and let's clear this out. Even though in this scenario, my call strike that I've sold is higher than the put strike. As I mentioned, it is the delta of the call option that is getting closer to 1 that's hindering more of the upside movement and countering the positive delta that I would have on the standard married put position. Rolling the put up now, I don't want to roll it above this existing call strike because that would actually create a bearish position. And ANET has been in a very bullish mode and been very strong. So that's not something that I want to create at this time. It's unlikely that in March expiration I even have a 133 strike. This is more for the weekly options with the single-digit strike differences. In March, it might just be the 135 put I could roll up to, which in that scenario would mean my put is higher than the sold call strike price, and that would create a bearish position. I would reduce the risk, but I'd also lower the potential max return. That being said, I would lower the risk to the downside by rolling this put up now, but I might increase the risk to the upside due to the fact that I'm creating a bearish structure. But let's take a look. What would it look like now if we rolled the March put up and left the call alone? Of course, as I mentioned, the strike prices we see, we only have the ability of the 135 and the 140. And typically in this case, since the stock's above 135, I'd be tempted to go up to the 140 to remain in the money for the best form of protection. Let's just use the 135 to start. We're going to simulate buying to close our March 130 put, and then we're going to add in the 135. So we're going to sell this, and we're going to buy the 135 at midpoint. Remember, a 4.2% risk with a 5.3 potential percent return. We're not touching the call. We're just adjusting the put first. Now let's put this at 1190. That's good. 1185, 970 midpoint, maybe. 1185 midpoint, maybe. Let's just take a look. Okay, we reduced the risk to 3.6%. And we keep the return at roughly around 5.3% based on the new cost basis. We added a debit of $215 into the position, which increased that cost basis up to $13,792. So this looks like a good position, but notice what we did here. That upper break even that we saw in the original position, where we started to go negative at about 164, 163, the upper break even has dropped now to 155. Because of the increased cost basis up to 13,792 or 137.92 per share, we look at it that way, and we still have the 133 call in place, countering the positive delta on the stock. A better combination to use might be to roll this up to the 136 call, as we saw, and then adjust the put, which would take our risk down further. This upper break even will be pushed back up above the 167, 165 range, and we'd have that higher profit of 6.8%. This is just an exercise of why I always emphasize following the married put technique in the blueprint. When you've sold the call, income method number 1, which is also discussed in the free white paper, The Sketch. Once the stock goes above the short call, the target, the goals, the action should be address the call first. Then look to evaluate the put option to lower the risk. Income method number 4, rolling up the put, is the only one that's really done at a debit. It might affect the upside profit, but it will lower the risk as well. But in this position, as the stock continues to move up, what's hindering the overall position is the sold call that's going to a delta of 1 as it goes deeper and deeper in the money. The put is not hindering the upside potential as much as the delta is getting lower and lower. Yes, I'm losing value on the put. It's declining in price, but I'm gaining more on the stock. But now that gain in the stock and that positive delta between the stock and the put is being countered by the sold call. I need to address that first before doing other adjustments. And again, of course, the full technique, the proper structure that we discuss for controlling risk to single digits, and the proper use of the 12, really 13 different income methods is discussed in the blueprint. It's an all electronic copy, so you get instant access when you purchase the blueprint. The content is available on our educational portal, learn.poweropt.com. So I just wanted to review that. Follow up to a look at the married put and recent income methods, what to do when that happens. The NEM position is doing well. Rolled that up to the 47.5 put. It stocks at 45.13, originally purchased at 42.32. We've got a 47.5 call expiring in 7 days. We could buy it back now for 11 cents. It's almost at our profit range where we'd look to buy it back for 80% realized profit on the sold call. And this position as it stands right now, again, in the Fusion portfolio radioactive trading, the good combination we want to see. Low risk of 3.8%, max return if the stock hits 47.5 of 4.6%. So looking at more of a positive return on this collar position now with having a risk lower than the potential max return.